The S&P 500 yesterday ended up red for the majority of stocks, giving us great opportunities to buy some more companies. Now today we are taking a look at some of these that have massive upside, and each one of them is at their 52-week low. Now we're starting off with the first one, Cisco Systems. As we can see right there at its 52-week low with a double buy rating and a hold from quant. It also has a nice forward yield, 3.55%, and a forward P that sits around 12.2. Now over the last year it is down around 15%. Over the last 10 years though it is up around 85%. Bear in mind, if you reinvest dividends, it would be up slightly higher, and we can see all-time high December 2021, nearly 3 years ago, at $63. So when we take a look at the underlying metrics, we have a very safe dividend score, 91, and we also note this year, fairly mediocre increase to the dividend, 2.6%. Remember, on this channel, we want a minimum of 4% just to keep up in line with inflation. And we can see very safe dividend score ultimately means that a dividend cut is highly unlikely. Now on this channel, as always, we do like to look at some of the key metrics from the last recession, in fact 07-09 Great Recession. We don't have any comparative data for the dividend as they didn't pay a dividend during that period, but they pretty much had average growth, negative 14%, S&P around negative 12, and they marginally trailed the S&P on return, negative 59, S&P coming in at negative 55. As we mentioned, fairly mediocre increase this year. Over the last 5 years, at least increasing in line with inflation. Over the last 10 years, love to see that double-digit increase on average. We also note they have increased those dividends for the last 12 years. Now, talking about dividend yield theory, it is something we always use as part of our analysis. Tells us a company is undervalued when the current yield sits above the 5-year average, 3.55 versus 3.11. Another marginal undervaluation signal, 13.1 on the forward P versus the 5-year of 13.8. We in fact today get a triple undervaluation signal as the sector P of 23.5 is much higher than Cisco's 13.1. Do bear in mind we're not looking at any one of these models in isolation. We will conclude when we look at the valuation. We then get to the free cash flow payout. As always, below 60%. Does give us faith they can continue to offer some very strong increases. Well look, over the last 10 years, below 60%, 33 in 2023, and a marginal increase to 44 over the next 12 months, which is still well below our 60% target. Then for the free cash flow per share, we want to see consistent increases over the longer term. We note it has more than doubled, not very consistent, but again, on a year-on-year basis, it does look very healthy, although we do have to point out over the next 12 months, it is anticipated to drop to around 364. We then get to the sales growth, where ideally we want to see 3 to 7%, at a bare minimum the 3 to 4 just to keep up in line with inflation. Now we note 3 of the last 10 years have been negative, although we like to see this, the last full year, double-digit increases at 11%. And we can see over the longer term, at a minimum, they are at least keeping up in line with inflation. Now, one thing that Cisco have done very well over the last 10 years is returning excess cash to investor pockets through more than 1 billion shares outstanding that have been bought. So that is a good sign, ultimately giving you a larger ownership of the company that you are invested in. We then move on to the ROIC, return on invested capital, 10% or more. Give us faith, management are able to effectively allocate their capital. And we do note not only above 10%, but increasing over the longer term. The last few years in the mid to upper 20s, a very strong sign of this company's management. And we also like their margins, both operating looking very strong, consistently above 12%. A little bit of operating efficiency as it has increased over the longer term, so has the revenue, and the free cash flow margin consistently above 5% and looking very strong, one that you could classify as a free cash flow machine. We then get to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Why we focus on this, it correlates to dividend safety, which we saw as very safe, as well as the balance sheet strength, which looks very good. Below 3 is what we want to see, and the numbers you see below show us the number of years it would take the company to pay off their debt net of cash on hand. 0.62 on a trailing 12-month basis, 0.67 over the next 12 months, looking very strong. I mean, over the last 10 years, it wouldn't have even taken them one day to pay off all of their debt net of cash on hand. Now we want to jump into our intrinsic value, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So typically on the channel, when we do deep dives, we run through how we got to the intrinsic value. We go through every single model in detail. Today we're getting straight into it. First thing we want to point out though, the intrinsic value isn't dissimilar from Wall Street and their upside of 33%, their price target there at $60. As we mentioned at the beginning of the episode, each one of these stocks has a lot of upside. That means it should be a consideration in your own portfolio. Now we don't stop there with our analysis, we do a margin of safety. On this channel we execute on 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward looking data. Now if you believe that it is a buy up to $54, then we keep going till it's near the current trading price, and what we can see in today's episode, you are getting a 25% MOS based on the current value and upside of 33%. And as we said, we did get 2 buy ratings and it does have a fairly decent starting yield. As always though, do let us know your thoughts as we go along these stocks today. We also want to let you know we have released our latest free weekly article. If you want access to this or any others, you can click on the pinned comment below, sign up, grab a copy and start reading straight away. We have also released our 35 undervalued stocks to consider for August, and for each one we talk about whether or not we hold it within our own portfolio, so do go check that. The next stock we're talking about is Global Payments. Now this one again trading right there towards its 52-week low. Double buy rating, although this time we get a sell from quant as opposed to a hold from the previous stock. A forward yield that sits just above 1% and a forward P that looks very cheap at around 8.55. Now over the last year it is down around 19%. Over the last 10 years though, you would have significantly outperformed the S&P, up 180%, and we can see all-time highs around 2021 at $218, and we can see right now it is trading below 100 mark. So in terms of the dividend safety, we have a score of 70, so it does look to be safe, and we can go through the same metrics as we previously did. So in terms of the rating, it is safe, so a dividend cut is unlikely. And in the last recession, while they maintained the dividend, didn't increase it, but also didn't cut it, they had above average growth at 7%, and they also outperformed the S&P with their negative 38% return. Now we are still waiting on an increase for over the last few years. However, what we do know, 90% increase on average over the last 5 years and 17% year on year for the last 20. So that is very strong to note. And whilst they have 0 years of consecutive increases, they still have been paying a dividend, in fact 22 years without a reduction. Then we move on to dividend yield theory, a undervaluation signal on the yield, another undervaluation signal on the forward P, which sits at 8, significantly lower than the 5-year of 14, and we can also see much lower than the financials, which right now is around 11 for the sector. In terms of the free cash flow payout as well, it is significantly below the 60%, 16 in fact in 23, 8% expected over the next 12 months, so no surprises why on occasion they have ramped up these dividends at a very high rate. We just want to see that consistency moving forwards in terms of a year-on-year increase. We then move on to the free cash flow, where we do see more than double growth over the last 10 years. Very minimal growth though when we just look at it from the last 5 to 6 years. Nice to note, over the next 12 months, they are anticipating a massive ramp up to their total free cash flow. Then we look at the essential sales growth, where we want that 3 to 7%, very inconsistent on a year-on-year basis, but ultimately when we do zoom out and look at it over a 10-year period, we do note more than tripled their top line from 2015 to 2023. Now, shares outstanding, the previous company did some share buybacks. What we note here is, whilst this one has also done some share buybacks from 2020, when you zoom out, the net point here will be share dilution, increasing from 135 to 259. But again, do bear in mind from 2020, they have started to ramp up these share buybacks. We then move on to the ROIC. Now, as we mentioned, we really want to see 10% at a bare minimum. They have struggled, 5% over the last 2 years, 6% over a trailing 12-month basis. Just nice to note, it has been increasing from the COVID lows of 2%, something to probably keep an eye on and factor in when we do come to our margin of safety shortly as well. Another company with some very nice margins, well above the 12%, and in fact from the COVID lows it has been increasing and expected to increase again, as we can see on the trailing 12 month at 25%. Free cash flow as well, well above 5%, another very good free cash flow machine that does look to be very healthy and fairly consistent when you do zoom out. Now, the one issue we have with this company is the debt levels. As we can see, below 3 is what we want. Pretty much been above that, even if it is marginally for the majority of the period. 3.55 in 2023. Yes, it is anticipated to come down over the next 12 months to 3.27. We just want to see this come down and consistently be down for quite some time. So what does the valuation say? We have our intrinsic value at $152. Now, Wall Street is lower at 144. However, that itself is 45% upside, so definitely one to consider if you do like this company for the longer term. Now, before we get into our margin of safety, just to let you know, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for GPN or any others. So MOS at 10%, a buy at 137. Then we keep going till it's near the current trading price, and we can see quite a considerable amount today at 35%, pretty much right on today's price. So similar to Cisco Systems, a very nice MOS, 35% to be exact, with Wall Street giving this 45%. Again, do let us know your thoughts below whether or not this is one you have been accumulating. We then move on to Estée Lauder, where we have a double buy rating. Again, another sell from Quant, trading right there at its 52-week low with a forward yield of 2.9% and a forward P that does look fairly high at 41. But bear in mind, if we were to look at this in detail, there may be one-off non-recurring items that does bring this down in the next year. Over the last 12 months, though, it is down 46%. Over the last 10 years, up 23%. And we can see pretty much downward trending from the highs in December 2021 at $370. So in terms of dividend safety, well, actually we have a borderline safe score of 50, and they haven't increased that dividend since November 2022. What does a borderline safe score means? Well, ultimately that there is a moderate risk of a dividend cut over a full economic cycle. In terms of the last recession, well, again, maintained, didn't increase, didn't cut. Average growth, negative 11%, and a near S&P return, negative 52. In terms of dividend growth, whilst we haven't seen an increase since November 22, over the last 5 years and the last 20 years, they have still managed to increase this at a fairly strong double-digit rate. And we can see 3 years of consecutive increases, with 3 years as well of paying a dividend without a reduction. Now, when we talk about dividend yield theory, we get a massive undervaluation signal. 2.88, the highest yield they have offered over the last 5 years, 0.96 as the average. And in terms of a forward P, we can see here 25, much lower than the 5-year of 41.5. But we do note still sitting higher than the consumer staples of 17.6. Now let's talk about the free cash flow payout. Whilst we do see it below 60% every single year, we can see it is negative in 2023. As we're about to find out, that would have been the year that they posted essentially negative free cash flow. Also notice over the next 12 months at 72%, a little bit higher than maybe we would like to see, and probably does contribute to essentially that borderline safe score. Then we talk about the free cash flow. As we mentioned, yes, it has more than doubled from 2014 to 2022, but we do note 2023 at negative 435. But again, very nice to see. It is anticipated to rebound positive to around 369. Then we look at the sales growth. Not that nice to see the more recent year of a double-digit decrease to the top line revenue, but we can also see this has happened 2 more times, 2015 and 2020. But in fact, the other years, it has actually looked very strong, so hopefully they can turn this around, because ultimately when we do look at it over the last 10 years, they have increased that top line by around 50%. The other thing to notice, whilst the share outstanding has been decreasing at a very small rate, nothing too consistent either, so not much to discuss. ROIC as well, we'd love to see some very strong numbers at 35%, 30 in 2014 to 2016, but since then it has been coming down. Granted, 10% is still very nice to see in 2023, but look, trailing 12 month at 7% does make me worry a little bit that this is going to continue to come down into the mid to low single digits, but ultimately we can see whether or not we have enough room in our margin of safety. Operating margin as well, looking very strong up to 2023, where it sits at 11%, even lower on the trailing 12-month basis. And the free cash flow looking very healthy up to 2022, negative in 23, but as we saw, expected to rebound in 2024, which is probably, having looked at this information, why the share price has crashed nearly 50% over the last year. Now, it is nice to note the net debt to EBITDA is consistently below 3 1.97 in 2023, 1.79 over the next 12 months. As long as they can continue to keep this below 3 and that dividend payout ratio doesn't exceed the 70% mark for 2024, then hopefully this dividend can continue to be paid at a very strong rate and well above the 5-year average. Then in terms of the intrinsic value, $138, not dissimilar from Wall Street's 136 at 49% upside. So again, another one with massive upside to seriously consider. Margin of safety then at 10%, a buy at 125, at 20 at 1111, at 30% $97, and at 35% pretty much around the current trading price. So if you can bag this at $90, you're getting a 35% margin of safety, very similar to what we saw at GPN, with upside of 49%, massive upside. Again, that is if you do believe in this company and they can execute, turn things around over the longer term. We then move on to the Walt Disney company that in fact reported its earnings yesterday with a double buy and a hold from quant. Again, trading right there towards the 52-week low with a yield of just over 1%, a forward P below 18, and over the last year, pretty minimal movement, negative 1%. Over the last 10 years, negative 2, so a very poor return if you did invest 10 years ago. And we can see ultimately all-time highs March 2021 at around $200. Since then, though, it has come down. So do bear that in mind. And when we take a look at this, they did recently pay a dividend or restart the dividend, so no score as of yet. When we take a look at some of the information, well, historically, there is a negative 29% increase to the dividend, or we should say ultimately decrease, given the cut they had. Over the last 20 years, 2%. Now, as we mentioned, they did reinstate the dividend after not having one for several years, so it will remain to be seen how much they can continue to increase that over the longer term, because ultimately 11% payout in 2023, 20 over the next 12 months does give me faith that they can kickstart this increase at some very rapid double-digit rates that ultimately we do love to see. Now, no surprises, free cash flow did drop during COVID. Ultimately, the entertainment part of this company, the parks, will have been closed down during a vast majority of the COVID era. And what we noticed since the lows of 2022, it has rebounded sharply in 23 and expected to nearly double into 2024. So a good sign, especially if we can see the highs that we saw in 2018 and continue to move well above and past that. Top line revenue, well, actually nice to note, very strong growth over the longer term. Granted, we have that COVID drop and another drop in 2017, but 7% in 2023 is the upper end of what we want to see at the 3 to 7% level, and we can see nearly double the top line growth over the last 10 years. Now, there was a period from 2014 to 2018 where they were doing share buybacks, but what we noticed from 2018 onwards, they would have diluted your position, and that is ultimately the net position over the last 10 years, with no real movement of the shares outstanding from 2021. ROIC, as we just mentioned, we want to see it more towards the 10% level, but nice to note from the lows of 2%, it has started to increase, and ultimately we want to see it go back to the 17 to 20% that we have seen with Walt Disney. In terms of the margins, what we would say here is from the lows of 2021, it has started to increase, and this is a very good sign in my opinion if they can continue to move these margins higher. So ultimately what we want to see around the mid-20s, due to that is how they formed consistently from 2014 to 2018, then this could be a very good value play. And in terms of the free cash flow margin, the same message to be said. Lows in 2022 rebounded to 6% in 23, 9% on a trailing 12-month basis. We want to see it in the mid-teens that we have historically seen. So that is one of the reasons why we do get a drop in that share price, and that is something you need to consider whether or not you believe it is worth taking on a chance on this company. Now, in terms of the net debt to EBITDA, it did hit very high levels in 2020, above the 3 we want to see. Since then, it has come down and pretty much stabilizing around the 2 mark and expected over the next 12 months. Now, in terms of the valuation, look, straight away, our intrinsic value again is not dissimilar from Wall Street of 127. They see nearly 50% upside for Walt Disney, and with the current price at $85, we do believe there will be a very nice margin of safety. Well, 10% at 111, at 20% around $99, 30% around $87. So pretty much trading at around the 30% margin of safety with upside of 49%. As always, do give us your thoughts as we go along, whether or not you are considering any of these companies with significant upside over the next 12-month period. We then move on to Halliburton Company, where we get another double buy and a hold from quant. This one is also trading right there at its 52-week low with a yield of 2.21% and a forward P sitting below 10. Over the last year, well, down 22%. Over the last 10 years, down 55%. So again, do factor that in. Although we do notice the all-time lows, or at least over the last 10 years, was sitting during that COVID drop at around $6. So if you did buy this, similar to any other oil and gas companies, you would be up fairly strongly, in fact nearly 5 times. In terms of dividend safety, well, borderline safe at 60. Nice to note an above inflation increase in January at 6.3%. Now in terms of the last recession, well, another one that maintained the dividend, and we noticed below average growth of the S&P and did trail the S&P, although marginally at negative 59%. Now whilst we do see that increase in January at 6.3%, over the last 5 years it is negative 2%. Over the last 20 years, marginally increasing it above the inflation rate. And we can see now 2 years of consecutive increases. No surprises that they did cut that dividend during the COVID era, which many of these companies did as well in the industry. So again, no surprises at all. In terms of dividend yield, well, a nice undervaluation signal with the yield sitting higher, as well as the forward P at 9.6 below the 5-year average. We also do note it is well below the energy sector at 12, so a triple undervaluation signal for Halliburton. In terms of the free cash flow payout, well, below 40% for oil equipment providers. That is what we pretty much see over the last 4 years and anticipated over the next 12 months. So we should expect some nice above inflation increases to continue on the dividend. The free cash flow also looks pretty healthy as well. When we look at it from 2014 of 92 cents, it has more than doubled, moving in the right direction and expected to continue the upward trajectory over the next 12 months. Now, sales growth, bear in mind with this industry, it is fairly cyclical. That is why we do note 4 of the last 10 years to be negative. Last 2 years, though, looking very strong at that double-digit rate. And when we do zoom out, we can in fact see that the levels were sitting much higher for the revenue at 33 billion, and it came down to around 14 in 2020, and then it started to pick up. So bear in mind the cyclicality. Ideally with these companies, we want to be buying them when they are out of favor and riding them to when they are massively in favor with investors. Now ROIC, for the majority of the part, it is around the 10% level, although fairly inconsistent. Last 3 years though, nice to report, it has looked around that level at a bare minimum. In terms of operating margin, again, pretty much the inconsistency and the cyclicality does show throughout every single one of these metrics. Some years they look very strong, some years they do look very poor, but again, that should be absolutely no surprise to investors at all. In terms of net debt to EBITDA, below 2.5, which is what we see from the highs of COVID at 3.1 in the more recent years, coming all the way down to 1.25 and anticipated to come down even lower over the next 12 months, so the balance sheet does look to be fairly secure. Now, when we get to the valuation, first thing to point out, Wall Street see this with a lot of upside, 52% in fact, at a $47 mark. We have it at just below that at around $46, with the current price trading at around $31. So in terms of margin of safety, at the 10% level, we get a buy up to $41. Then we keep going till it's near that current trading price, and what we see, you are getting at least a 30% MOS based on the estimates and judgments that we have gone through for this company. And as we said, Wall Street consider this one of the most strongest companies for the portfolio at 52% upside. As always though, do let us know your thoughts in the comments below. Are you adding to any maybe on your watch list, or for whatever reason they're not ones that you do consider? If you enjoyed the episode, well, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to come and join us for the free weekly newsletter by clicking on the pinned comment below, as well as the Patreon if you want to discuss our weekly buys and sells. As always, have a great day, and we'll see each and every one of you on the next one.